Welcome back everybody to Altcoin Daily. My name's Austin. In today's video, I want to share with you one of the most heavily requested video topics that we've had by you in a very long time: when to sell your cryptocurrency, the ultimate Bitcoin and altcoin profit-taking guide. At least my strategy, what I'm doing. Keep in mind, I am not a registered financial advisor, so do your own research, make your own decisions on what works best for you. But as Bitcoin again approaches 65K, as it again potentially is about to blast through its all-time high, now is the time to discuss this. I'm going to share with you 3 different tools on how to spot a trend change in the market, strategies that other people use on when to take profits, and then finish by talking about my strategy, what I'm doing, what my personal plan is. So like always, check the timestamps down below in the video description, hit like, and let's jump in. Number 1, a great tool to have in your arsenal is looking at the 200-day moving average. Bull market or bear market, why the 200-day moving average can help you. And this is a very respected metric used in traditional markets, the stock market, etc., and of course, the crypto market as well. So what is it? What is the 200-day moving average? Well, it takes the price of any asset, in this case Bitcoin, the daily closing price over the last 200 days, and divides it by 200. So it takes the average, shows momentum of the market, and it's great for showing whether the market is in an uptrend or a downtrend. And with this, you're never going to get exact tops or exact bottoms for the market, but you will get a general direction. And that's what I like about it. If we're above the 200 MA, then we're in a bull market. If we're below the 200 MA, then we're in a bear market. Generally speaking, that's how it works. Now, it's not the end-all be-all. This is one metric in your arsenal that you should use among many metrics. There are exceptions to this. For example, earlier this year, with that 50% drawdown from 65K, we crossed below the 200 MA, which should indicate a bear market. But because so many other metrics were still pointing bullish, we were very loud on this channel that momentum was still pointing bull market. At the moment, looks like we were right. So the 200 MA, great metric to use, and just for consistency, for clarity, we can go all the way back to 2012. And even in this 2013 double bubble that a lot of people are comparing this cycle to the 2013 cycle, we can see that the 200 MA was a great indicator. In this first bubble, had a bit of what looked like a blow-off top, heavy correction, and even though we actually dipped under for maybe half a day, we held support of the 200 MA and we kept going further. Point is, always wait for some form of confirmation. Don't be fooled by these fake outs that we may see. We want to see a clear trend change. And one more thing, you may be saying, Austin, if I go by the 200 MA rule, it looks like I'll miss the top every single time. And my response to that is yes. We are never going to get the exact tops or the exact bottoms. We just want to see a trend change in the market. Bull or bear. I hope I didn't ramble too much on this. Give me your thoughts down below in the video comment section, but let's keep moving. Next up is a strategy that I think many of you already use. It's called dollar cost averaging. That's where you invest little bits over many increments of time instead of one lump sum all at once. Now, many people use dollar cost averaging to invest into an asset. You can also use dollar cost averaging to take profits. Dollar cost average out of an asset. That's what I do. And why? What is the benefit? Dollar cost averaging can help take the emotion out of investing. It compels you to continue investing the same amount, or roughly the same amount, regardless of the market's fluctuations, potentially helping you to avoid the temptation of trying to time the market. Now, you can dollar cost average in or out one of 2 ways. Either it would be maybe every paycheck, whether it's every 2 weeks, every month, putting $100 into Bitcoin, $100 into crypto, every 2 weeks regardless. Or another way is dollar cost averaging and buying the dips. This is when you DCA by buying more shares of an investment when the share price is low and fewer shares when the share price is high. This can result in paying a lower average price per share over time, aka buying the dips, great strategy. And by waiting in or waiting out slowly, as opposed to handing over all your money all at once, dollar cost averaging can help limit your losses in the event the market declines. Now, what that would look like is this. Let's just take the 2017 run up, for instance. Let's say we bought when we crossed over that 200 MA the second time, when we saw the clear trend change, and we're obviously not going to get exactly. So let's just say we bought around we loaded up when Bitcoin was around $300. Now back then, a $10,000 Bitcoin seemed like a pipe dream at the time. People were hoping, but it seemed near impossible. A lot of people probably sold earlier, maybe at the 10x, maybe when Bitcoin is around 3,000 instead of 300. So dollar cost averaging, maybe start by taking 10% of your investments as profit. Sell 10%. If it keeps going up, sell another 10, sell another 10, sell another 20 if you get to unconceivable amounts. This is all very personal to you. But just like we dollar cost average in, we're never going to get the exact bottom. We dollar cost average out. Great strategy. I personally love it. But what do you think? Give me your thoughts on DCAing down below. Is it a strategy you like, or do you prefer other strategies for taking profits? Checking the comments now. And by the way, this is what I'm going to do, because one of the big reasons that you subscribe to Altcoin Daily is because it's not just our voice. Sometimes we bring on other notable investors in the space and hear their voices. So I'm going to link 3 interviews if you want to hear Anthony Pompliano's investing strategy as well as profit-taking strategy into 2022, link down below, as well as macro investor Raoul Paul's profit-taking strategy as well as investing strategy into 2022, link down below, and even some more fun ones, like Gene Simmons' investing and profit-taking strategy. This one's more fun, not about being an expert. All 3 interviews are linked down below, an opportunity to hear many different personal strategies. And strategy/tool number 3, before I get to my personal strategy, is looking at the on-chain data for Bitcoin and crypto. And this tool is very specific to cryptocurrency because for the first time ever in human existence, we have all the data on the blockchain. In the stock market, we have no clue how the stocks are trading hands, what's happening behind the scenes. Yes, we have quarterly reports from the CEOs where they share the inner workings of the company, but we have to trust that. With the blockchain, you do not have to trust because we have the ability to verify. And let me show you exactly what I mean, the type of data we're able to see and what it tells us. From Glassnode, Bitcoin's on-chain activity has been on a consistent grind higher through August through October. Many activity metrics are up 24% since the 29K low set in late July. Active addresses for wallets are up over 179,000 per day. Active entities, which is more specific than wallet addresses because one person can have multiple wallets, active entities are up 51,000 per day. And then, of course, entity-adjusted transaction counts up over 43,000 per day. So this on-chain data, this right here, very telling about where the Bitcoin price is headed. And this is one of the reasons when we saw that 50% correction back in July, many people were screaming bear market, screaming we're heading to 10K. The on-chain data said otherwise. The on-chain data from that July low was screaming bullish, screaming still in a bull trend. In retrospect, a great time to buy the dip, and subscribers of this channel got this information first. We shared with you first. And there's so many different on-chain data and statistics we have access to. For example, the miners. What are the miners doing? Because they usually have a pretty good pulse on the state of the market. This is a tweet from Sentiment for Ethereum from just yesterday. Ethereum has returned above $39,000 for the first time in about 6 weeks. And an interesting phenomenon has been the absurdly rising miners' balance. Miners are still accumulating at these prices. In the past 3 months, miners have added over $580,000 worth of ETH to their currently already large holdings. So they're still accumulating. We can see what these network entities are doing. And last but not least, a metric that we've referenced many times on the channel is net inflows and outflows of balance on exchanges. If people are sending their Bitcoin onto exchanges, they're getting ready to sell. If Bitcoin continues to leave exchanges, we're running out of supply. People are still accumulating. Such revealing information that we cannot get in the stock market, we can only get on the blockchain. Okay, let's get to the good stuff. What's my strategy? because we covered 3 tools: the dollar cost averaging, the 200-day moving average, and the on-chain data. 3 great tools to have in your toolbox to better understand a bull or bear market, when to sell, when to buy. Of course, you're making your own decisions. But what's my strategy? If you want to realize profits, but you don't want to sell because that creates a taxable event, you can take out what's known as a crypto-backed loan. Crypto-backed loans allows you to access liquidity without selling. You can use Nexo, you can use Celsius, you can use Compound, you can use sponsor of the channel BlockFi, link down below. But by using your crypto as collateral, you can unlock up to 50% of the value of such assets in USD, and we can fund you on the same day that we receive the collateral. The rates are very transparent, which I like, and all you need is a BlockFi account at blockfi.com/altcoin daily. And you do not need to sell your crypto if you don't want to, and you can still take profits without creating a taxable event by accessing that liquidity. Also, if you live in the US, I do want to recommend the blockfi.com Bitcoin Rewards credit card. Earn an unlimited 1.5% back in Bitcoin on every single purchase. There is no annual or foreign transaction fees, which I love, and you can earn up to 3.5% back during your first 3 months. One of the easiest ways to accumulate passively. Check it out, link down below. That's blockfi.com/altcoin daily cc. Check it out. Alrighty, let's talk about me. What's my strategy for selling cryptocurrency, taking profits at the end of the cycle? Well, first off, I will say that I'm pulling from many different tools in my toolbox. I like to use TA, I of course like to use dollar cost averaging, and I especially love, and things like this is probably what I find most valuable, fundamental analysis on chain data. So I'm using everything. And I would say I accumulated the most Bitcoin and cryptocurrency for me in these last 4 or 5 years, probably the most between $6,000 and $12,000 Bitcoin, and then also a lot at this $29K, $30,000 dip. So point is, I've been accumulating. And I consider myself a long-term hodler, meaning not a swing trader, not a day trader, maybe a cycle trader. I'll take some profits at the end of a cycle, or where I think that potentially is, but I'm in this for the long term. If/when Bitcoin gets to 100K, whether that's next month or whether that's 3 years from now, I'm not thinking about taking profits till Bitcoin at least surpasses that psychological 100K level. And I'm willing to wait. But point is, for me, that's when I start thinking about taking profits. I check in to see where we are with the fundamentals. But at 100K, that's when it gets on my radar, start thinking about it. And depending on where we are, you start dollar cost averaging out. Also for me, even though usually Bitcoin pops off and the altcoins tend to follow a couple weeks later, but because I'm pretty risk averse and also I'm never going to catch the exact top, I take profits from my altcoins, put it into Bitcoin or put it into stable coins, and then have some cash reserves to buy more Bitcoin or buy more select few altcoins. I hope that's clear. That is my general strategy. If you have questions, feel free to comment down below. I'll answer them. Or if you have a different topic for a different video, please comment down below, share your thoughts. But that's the video. My name's Austin. See you tomorrow.